All right, good afternoon, everyone, and welcome to today's Headline Roundup. Today is September 26th. Before we bring Dennis on, I just wanted a quick update. I know there was an issue with, well, we had several issues last week with our presentation on the technical side of things. And then when we uploaded it to the website, there were still some more problems. So again, apologize for all of that, but the replay is now working on the website and your RLA app. So if you want to check out last week, it's there. And I did remove all of the conversation around the technical issues we were having. So it's a good, clean presentation. Anyway, without further ado, let's get into today's. Dennis, you ready to go?
I am ready, Mark, and looks like we're off to a much better start, so appreciate that update. We do have an opportunity again to ask questions or make comments. Go to the questions box on the right-hand side of your screen, typically. Type it in. Mark will help me keep an eye on the questions, and if you have a question, we'll be sure to answer it, and if you have a comment, we'll pass it along. That said, the Federal Reserve raises interest rates once again last week. I'm sure that's not news to most of you. In my view, and the view of many others, still far short of what's needed if the goal is to contain inflation. The markets, stocks in particular, did not like what the Fed had to say. They reacted extremely negatively. Wharton professor Jeremy Siegel said the Fed is making another mistake. The housing decline, as I've been discussing this year, I felt that the housing market would follow the stock market down. The numbers are now bearing out that that is the case, and we're already seeing the mortgage industry feeling the housing decline. So that's what we'll be talking about this week. This is from the Mises Institute. I don't think it's any surprise that I look at the world from a libertarian perspective, and economically speaking, I think the Austrian School of Economics makes a lot more sense than the Keynesian school. We do have Keynesian economists running monetary policy today, and I think that just taking a look at where we are today, that alone makes a pretty good argument that the Keynesian approach is not the best one. This is from Ryan McMakin at Mises. He said this: when asked about price inflation in his Sunday interview with 60 Minutes, President Biden claimed that inflation was up just an inch, hardly at all. Biden continued the dishonest tactic of focuses on month-to-month price inflation growth as a means of obscuring the 40-year highs in year-over-year inflation. This strategy may work to placate the most ignorant voters, but people who are paying attention, or anybody buying groceries for that matter, knows that price inflation continues to soar. The Federal Reserve knows it better do something about price inflation, which even the Fed now admits shows no signs of even moderating. I find it interesting, although on this particular broadcast, I talked about it. When the Fed said that inflation was transitory, we said that it was not. Inflation is a direct result of the amount of currency that was created. The Fed created $5 trillion literally out of thin air, and we're now seeing the consequences of that. So last week, Wednesday, the Fed's Open Market Committee announced that it would again raise the federal funds rate by 75 basis points. That's 0.75% or 0.75%. Here's a bit from the Federal Open Market Committee press release. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. The committee decided to raise the target range for the federal funds rate to 3 to 3.25% and anticipates that ongoing increases in the target range will be appropriate. So the Fed has said, you know, we're just getting started. We're going to have to continue to raise rates. I'll talk in a minute about why I think that they may raise rates a bit higher, but I believe they will at some point in the relatively near future reverse and reduce rates again. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities as described in the plans for reducing the size of the Federal Reserve's balance sheet that were issued in May. The committee is strongly committed to returning inflation to its 2% objective. Now, McMakin notes that this is by far the most hawkish announcement yet out of the Powell Fed, and it no doubt reflects the fact that the Fed has finally come to terms with the fact that inflation is not transitory, as the Fed has long insisted, and it's now impossible to deny. You can't say something is transitory or temporary when it lags on this long, so the Fed was forced to change the narrative, and now they're talking tough, but as I just noted, I don't believe the actions will necessarily follow the tough words. Last month, consumer price index inflation rose 8.2% year over year, marking 6 months of year-over-year price inflation rates over 8% and near 40-year highs. So if you take a look at the furthest right note on this chart, you see inflation is quickly rising. This is the Fed funds rate. So you can see the Fed funds rate is quickly rising. We have not seen a Fed funds rate this high since at the time of the financial crisis. Moreover, in its summary of economic projections, many FOMC committee members said they expected the target policy rate to reach or exceed 4.25% this year and exceed 4.5% in 2023. Now, if we take 4.5%, that still gives us real negative interest rates. You cannot get inflation under control unless interest rates are positive on a real basis. If you have year-over-year inflation at 8.6% using the severely flawed consumer price index as your metric, you still have negative interest rates of 4%. This does not get inflation under control. Now, in spite of 2 quarters in a row of shrinking GDP over the past year, and in spite of many indicators of brewing recession, such as falling home prices and inverted yield curve, the committee is still clinging to the idea that the Fed can steer a soft landing in which inflation will be reined in or controlled with no more than some moderate slowing in economic growth. I believe that, as I noted at the bottom, this cannot and will not happen in my view. I think the Fed knows this too, but if you're a monetary policymaker, you need to put the best face on the current situation. As I noted earlier, the Fed would still be using the transitory narrative if it was believable, but it's not. Price inflation is getting bad enough that the Fed is now saying, we are going to do whatever it takes to fix it. We're going to have higher rates, and even if it means job losses, even if it means economic pain, we are going to stay the course. I don't expect they will. McMakin says, although the recent hikes in the target Fed funds rate suggest an increasingly hawkish position, the Fed nonetheless continues to take only the most tepid steps when it comes to reducing the size of the Fed's portfolio. In other words, despite tough talk, the actions really are not congruent with the talk. We still have real negative interest rates, probably more than we've ever had at any point in history. Such a move would directly reduce the money supply by reversing quantitative easing or currency creation, and it would also reduce asset prices by producing a small deluge of government bonds and mortgage-backed securities flowing into the market. In other words, if you flood the market with an asset that you want to sell, and the market is inundated with that asset, then you see prices fall. While the Fed is allowing some government bonds to continue to roll off the portfolio, we shouldn't expect any drastic moves here. It's been nearly 4 months since the Fed announced plans to reduce the portfolio. Yet, despite that announcement 4 months ago, the actual reduction in these assets continues to be minuscule. Moreover, in Powell's press conference on Wednesday, when he was asked about selling off the Fed's mortgage-backed securities, Powell said this, quote, "It's something I think we will turn to, but the time for turning to it has not come. It's not close." In other words, Powell's saying we can't dump a bunch of mortgage-backed securities on the market because rates are already high. The housing market is already suffering. Even now, after immense and rapid price inflation over the past 2 years, the Fed is still too afraid of fragility in the housing market to put much of its $2 trillion mortgage-backed security portfolio back into the private sector. This sends a mixed message as to how much the Fed is really committed to reducing price inflation. So again, as I said, I believe it's a lot more talk than it will be action. But it's clear Powell was trying to talk tough. He was trying to project a hawkish tone on Wednesday overall. Powell spoke of significantly reducing the size of our balance sheet and also emphasized that ending the current bout of inflation will require pain in the form of job losses. He also emphasized there is no short-term solution, strongly implying that the current effort to end inflation could possibly take years. That's simply because the federal government has too much debt to raise interest rates to where you need to raise them to get inflation under control. Powell expressed fears that price inflation will become much harder to address once the population comes to expect inflation as routine. We may be close to that already. He also noted that price inflation in housing is going to remain high for some time. I believe that's not the case, as I will demonstrate to you here, or attempt to demonstrate to you here on today's broadcast. Powell then reiterated there's no way to wish away inflation, but that the only way he says the Fed can do something about inflation is slowing the economy. Now, my notes, as I have previously discussed, the Fed cannot get inflation under control until real interest rates adjusted for inflation are positive. The Fed has gone from describing inflation as transitory to insinuating that the current battle against inflation could take years. And the Fed is now almost admitting that deflation will be necessary to get inflation under control. Ironically, inflation leads to deflation when your currency is debt. And that's ultimately where I believe that we are headed. Now, the stock market did not like what the Fed did. Since the beginning of the year, this is a daily chart of the exchange traded fund IVV. This tracks the price of the S&P 500. I've drawn a light blue bold trend line from just about the middle of the chart to the right. You'll notice I've drawn that trend line over the highs that we have seen. Now, if you notice the highs, we have a series of lower highs. That is typical and really a textbook bear market pattern. You also see a series of lower lows. So you see the lows across toward the bottom of the chart, and you see that right now, after the Fed's announcement last week, that the market's at a very critical place. This becomes even more visible when you move to a weekly chart. If I go back to the daily price chart, you see that every line on this chart represents 1 day of price action. The green bars represent days the market price went up. The red bars represent days the market price went down. Here, every bar in the chart represents a week. You see that year to date, the market is now down as of open this morning, more than 22%. You see I've got the same trend line there drawn over against the series, or drawn across the top of the series of lower highs. You also see lower lows, and if the market goes a lot lower, we are now going to see even lower lows. And the market could rally a bit here because it's extremely oversold. It doesn't have to, but I expect that we will break through these lows that you see here from back in May, June. I think we'll break through those at some point here in the relatively near future. Zero hedge, talked about this. Stocks tumble to session lows the moment Powell opens his mouth. S&P futures now clearly in widespread panic liquidation mode and searching for any excuse to sell off more. Found one just after 2 p.m. when Jerome Powell said the U.S. economy may be entering a new normal following disruptions from the COVID-19 pandemic. We continue to deal with an exceptionally unusual set of disruptions, Powell told business and community leaders Friday at a Fed Listens event in Washington. Algos immediately took this as confirmation that the supply chain chaos that defined the post-COVID world is still prevalent in the Fed's thinking. And since it is inflationary, it means even more rate hikes on deck. Again, we'll have to wait and see, but there's no doubt the market did not like what the Fed had to say. Today's markets are addicted to easy money. Now, Wharton professor Jeremy Siegel, who is a stock commentator and a well-known stock investor, said, "I'm afraid." He went on a rant against the Fed on Friday. He was on CNBC as the market was melting down, and he said the Fed made a massive error last year by not moving to tighten monetary policy before inflation got out of hand. And then Professor Siegel mocked Powell and crew for assuming inflation would simply fade away on its own. Siegel said this, quote, "When we had all commodities going up at rapid rates, Chairman Powell and the Fed said we don't see any inflation. We see no need to raise interest rates in 2022. And if you look back, that's exactly what Powell said. Now they have changed their tune. Now, when all these very same commodities and asset prices are going down, he says stubborn inflation that requires the Fed to stay tight all the way through 2023. Siegel said it makes no sense to me whatsoever. Siegel said he expects central bank errors to hit working and middle class Americans and what he thinks will be a serious recession. I would argue that we are there, and that instead of continuing to hike rates to tame inflation, the Fed should let falling commodity prices shoulder more of the burden. I think the Fed's way too tight, he said. They're making exactly the same mistake on the other side they made a year ago. So Professor Siegel's actually saying that deflation will ultimately cure inflation, but it's going to be painful. That's been my argument since the beginning of the year as well. I think the Fed will see deflation. They will attempt to pivot, to use that term, or reverse and lower interest rates, and it remains to be seen if they can be effective. I have my doubts. Let me also be clear that I don't know for sure. Now, deflation, if you're a new listener, is simply currency disappearing from the system. And when you have big deflation, you also have bank failures. Now, in another bit of evidence that the recession has begun and is here, the housing decline has begun. This is from Wolf Richter. The title of his article is Housing Bubble Woes. Housing prices dropped 3.5%. The steepest monthly drop since January of 2016. Sales already at lockdown levels drop further. Active listings rise further. So what I've been suggesting would happen in the real estate market now seems to be coming to pass. Mortgage rates are now 6.5%. Richter writes that in July and through mid-August, mortgage rates fell sharply from the 6% range in mid-June on the widely propagated fantasy of a Fed pivot on rate hikes. By mid-August, the average 30-year fixed mortgage was down to 5%, but yesterday they were back up to about 6.5%. But the brief interlude of dropping mortgage rates slowed down the decline in home sales, but sales declined again in August from July, but at a slower rate. Realtors in mid-August were saying, hey, this bull market in real estate's not over. We just had a bit of a slow month. But now all that happy talk is now transitioning back to talk that's not so positive after prices dropped again. The median price of existing family houses, condos, and co-ops whose sales closed in August dropped 3.5% in August from July. That's the largest month-to-month percentage drop since January of 2016 after a 2.4% drop in the prior month. While there is some seasonality involved, the percentage drop was bigger than normal in August, whittling down the year-over-year price increase to 7.7%, down from the 25% year-over-year increases last summer. And you see the median sold price of existing homes is now pulling back from the peak. The median home sales price got to almost $420,000. Now it's down to about $390,000. In the West, price drops are further advanced amid dismal sales. For example, in San Francisco and Silicon Valley, Median prices have plunged in recent months, now down on a year-over-year basis in San Francisco and San Jose, up just a hair in San Mateo County. Sales of existing houses, condos, and co-ops across the U.S. dropped a smidgen from July after a 5.9% plunge in the prior month to a seasonally adjusted annual rate of sales of 4.8 million homes. Beyond the lockdown months, it was the lowest sales rate since 2014 and down by 29% from October of 2020. If you take a look at the sales of existing homes, this chart really tells the story. Look how sales of existing homes are now dropping off big time. Haven't been this low since 2020. Sales of single-family houses dropped by 0.9% in August from July, but 19% year over year. Sales of condos and co-ops are down 25% year over year. That's roughly a 20% drop in single-family homes and a 25% drop in the sale of condos. Compared to August of last year, sales fell by 20%. That's the 13th month in a row of year-over-year declines. The chart tells the story. Look at the 13 red months on the right-hand side of the chart. The real estate market is beginning to reverse. Sales volume has been low because potential sellers are clinging to their aspirational prices of yesteryear when mortgage rates were 3%. A lot of sellers have decided they'd rather keep their home off the market or pull it off the market than sell for less, but price reductions have now taken off by sellers who want to sell. Price reductions started spiking in May from record low levels last winter and they sprang as sales stalled and mortgage rates surged. In July, price reductions reached the highest level since 2019, according to data from Realtor.com. In August, price reductions dipped just a little as sellers might have felt that price reductions were less needed because mortgage rates were declining. Active listings are also up. You look at this chart, total inventory in houses for sale minus the properties with pending sales rose to about 780,000 homes in August, up 27% from a year ago. So broadly speaking, inventories are up 27%, sales of single-family homes are down 20%, sales of condos down 25%. These are not good statistics. And the mortgage industry, not surprisingly, is already feeling it. Layoffs, shutdowns hit mortgage industry as high rates crush lending. If you take a look at mortgage lending by volume, take a look at the drop-off in mortgage lending, which peaked at the end of 2020 and has been declining really ever since. After getting laid off for her job at mortgage provider Better.com in March, Charmaine Steele interviewed at 8 other mortgage companies. Each one subsequently announced layoffs of their own, she tells Axios. At least one has gone out of business. It's lean times in the real estate business. A slowdown is a warning for the economy more broadly, and a rare labor market weak spot at a time of strong overall employment. As deflation kicks in and intensifies and stocks and real estate are more fully affected, more fully impacted, I expect that you'll see the labor market turn as well. Interest rates have now hit 14-year highs, forcing lending activity way down from the peaks of the past 2 years. Layoffs and shutdowns are now happening with alarming frequency. The housing market tends to lead the broader economy both into and out of recessions, says Mike Frantantoni, who's a chief economist at the Mortgage Bankers Association. Steele, to finish that story, who was looking for jobs at 8 different mortgage companies, said nobody was hiring anybody. Just last week, Tuesday, Compass, a real estate brokerage, announced the second round of layoffs just the day before, on Monday, Open Door, which is in the business of buying and flipping houses, announced it lost money on 42% of its transactions in August. Steele's former employer, Better.com, has done 4 rounds of headcount cuts. Real estate Redfin has laid off 8% of its staff in June. Rocket, one of the largest non-bank mortgage lenders, has done 2 rounds of cuts. Rocket was briefly a meme stock in 2021 and it traded over $25 a share. It's now less than $8. And small fintechs in the mortgage space have gone out of business. You see the names of the companies there. Mortgage, banking, and brokerage shops trimmed 3,600 full-timers from their payrolls in July, according to Inside Mortgage Finance. Hardly anyone is immune. If a lender isn't cutting staff, it's offering early buyout packages. Mortgage companies hired like crazy over the past couple of years as low interest rates drove a surge in refinancing. For a while, things were great for workers in the mortgage industry. Some companies were even paying 7-figure signing bonuses. That alone is the sign of a bubble. So that's what I have to cover with you this week. We're seeing some slowdowns. We're seeing the market not like it. We have terrific attendance today, so appreciate you guys spreading the word about everything that we're doing here. Mark, I'm not seeing any questions, but if you do have a question, go ahead and type it in the question box. If you have a comment, type it in there. Be very glad to answer your question or pass on your comment to our group today. And Mark, do we have any questions at this point?
There's one that just popped up from Brad.
Okay, I've got, in your opinion, we have some bonds in our portfolio. Brad, I guess I would never buy bond funds in this environment. Bond funds will go down as interest rates go up. It seems that we may be on that track. In fact, U.S. Treasuries are down, long-term U.S. Treasuries are down about 28% year to date. If you're going to own bonds, I would own highly rated corporate bonds and I would ladder the maturities. That's also what many insurance companies will do. So I'd want a laddered portfolio of highly rated corporate bonds, and I would enter into those bond purchases with the understanding that I plan on holding these bonds to maturity. I would avoid bond funds. I would avoid government bonds. I would avoid bonds in companies that don't have a lot of tangible assets. And I'd like only for highly rated corporate bonds, and I would plan on holding those bonds to maturity. So good question, good point of clarification. If you have a question, go ahead. Gary, gold and silver forecasts. Well, despite what's going on in the gold and silver market, gold, I believe, is down about 16% year to date. I am bullish on gold. I think that we are very much approaching the point that if it goes much lower, production will slow. And as the old saying goes, the best cure for low prices are low prices. So I believe that we're nearing that in gold. I believe we're there in silver. We are very near the production cost in silver. These are both small markets. There's a lot of leverage in COMEX. They're fairly easy to manipulate, but I expect the fundamentals will be positive for both gold and silver moving ahead, more so than certainly stocks and U.S. Treasuries. What we've seen here year to date, with stocks being down, gold being down, and long-term U.S. Treasuries being down, is an historical aberration. This typically has not happened historically. I expect that this will go back to something a bit more normal moving ahead. It's most reminiscent of when the Fed started to taper back in 2018. We saw all asset classes perform poorly. We're seeing that now, but I expect that if we're patient with gold and silver, that ship will right itself. So hopefully that answers your question, Gary. Thanks for the question. If you have a question, you can type it in the question box on the right-hand side of your screen. Well, Mark, I'm not seeing anything else but a great crowd today. Appreciate you guys spreading the word. Let everybody know what we do here every Monday. You go to retirementlifestyleadvocates.com. You can check out the the podcast version of the radio show. You can check out the replay of this Headline Roundup broadcast. And there's also the weekly Portfolio Watch newsletter there. So again, that's at the website, retirementlifestyleadvocates.com. And Gary, thank you for the nice words. Nice to catch up with you last week too, by the way. All right, I think, Mark, we can go ahead and conclude.
All right, we'll wrap it up there. We'll be back again next Monday, October 3rd, I believe it is already. So we'll see you then. Have a great week.